Now let's welcome in the Wharton professor of finance, Jeremy Siegel. Professor, it's good to have you back with us, okay? So people know where you have stood, you wanted the Fed to be more aggressive than most. And then you came to the, I think, view that you worried they were going to be too aggressive and they were going to push the economy into a recession.
Right.
The problem is inflation remains painfully too hot. What are they supposed to do now?
All right. Well, first of all, Jay Powell must be forward-looking. And honestly, the statistics we're getting are very backward-looking. I mean, I'm with Jim Cramer on this. Listen, you've heard me say, I've been saying that the housing, the way the government does the housing inflation is so lagged. We already had 20% increases in prices and rents. It's only recorded as 6 and 7 and 8, and it's going to get in there over the next 12 months. And it is a very big fraction. So the printed numbers are going to remain bad, even though the actual numbers are going to be getting much better. So, I mean, I presume that Powell knows this. If he just looks at the printed numbers, it's still going to be, it's going to go down. I mean, this could be the peak print. I mean, look what's happened. That was when oil was over, gasoline was over $5 a gallon. Mm-hmm. It's come way down. So, you know, the energy part will be much lower when we get the July print. But really, I think most of our inflation is behind us. I think, yes, they'll do 75. And they have to turn around because the economy is really slowing. I said we're in a recession. And by the way, I've commented the fact that we've slammed down the monetary brakes, the money supply, deposits in banks to absolutely flatten it out. And I have not seen that in any of the statistics that I've been following for the last 50 years. I mean, it is so dramatic in terms of the loss, the slowdown in liquidity. And that's very good for forward looking, but it also means that you got to be very, very careful about what that means for the economy.
Okay. So what then does that mean for stocks? Am I supposed to, because if I agree with you and Jim and Tom Lee and others, am I supposed to buy stocks today because this is it? This is it.
Yeah, I mean, I think, they've reacted pretty well. I mean, look what happened in the bond market. First, knee-jerk reaction, yields are going to go way up. And then they say, oh, my goodness, is the Fed going to get too tight? And then all of a sudden, you got the yields that are, almost below where they were before this bad print. I mean, I think you have December 23 funds actually lower than they were before this bad print. So the market itself is saying, are we going to be worried the Fed is really going to tighten too much? The market will bottom and rally. Maybe in the July, he does 75 and says, listen, we think we've made a lot of forward progress. The prints will still show high inflation, but we feel we've done most of the tightening. Wow. I want to be long on that day.
Okay.
It may not be July, but I want to be long on that day.
But maybe it's a gift then, if you want to use that word, that there is no Fed meeting in August. So they do 75 in July. They have the ability in Jackson Hole to say whatever they want. And in the meantime, before the next meeting in September, they have the benefit of two more reads. They have the July read, CPI. They have the August CPI, but before they meet again. So maybe that gives them the reprieve that they need to see what they need to see, so they don't have to necessarily do 75 in September. They can make that pivot at least to a lower increase, which gives the stock market reason to go up.
And by the way, the more important data will be the real data on economic activity, because that's going to be more sensitive. Because of the backward-looking nature of this CPI, if they just look at the CPI, they'll see it stubbornly high. But if the economy continues to slow the way we see, if the money supply stays flat the way we see, I mean, I see no other way but them to say, hey, you know what? It's going to be in the statistics, but we have really stopped the inflation. And I think that certainly can come in the real data more than actually the reported inflation data.
No.